39% of homebuilders slashed prices in November 2025. 65% are throwing desperate incentives at buyers. If you think that sounds like a healthy market, think again. This is panic. This is builders staring at mountains of unsold inventory, bleeding cash on carrying costs, and realizing the boom is over and the reckoning has arrived. Across America, from Phoenix to Tampa, from Austin to Charlotte, construction companies that printed money during the pandemic are now hemorrhaging it, forced to offer discounts rivaling distressed sales just to move product. We're talking $50,000 to $150,000 price cuts. Mortgage rate buydowns dropping payments from 7% down to 4 or 5. Closing costs paid in full. Upgrades worth $30,000 to $40,000 thrown in for free. According to National Association of Home Builders data, November 2025 marked the highest level of builder incentives and price reductions since the 2008 financial crisis. This isn't generosity. This is survival. Builders sitting on completed or near-complete homes they can't sell face a brutal choice: slash prices and margins to generate cash flow, or watch projects sit empty while construction loans compound and investors demand answers. But here's where it gets interesting for buyers. This builder desperation creates a rare window. For the first time in years, new construction isn't premium priced. It's competitive, sometimes cheaper than comparable resales when you factor in all the incentives stacked together. Does that make it a smart buy? Or are these deals trap doors into depreciating assets in oversupplied markets still correcting through 2026? Stick around, because we're breaking down exactly what's driving builder panic, which markets offer real opportunities versus dangerous traps, and how smart buyers can navigate this landscape to score legitimate deals while avoiding the landmines. Hit subscribe to Housing Intel, and let's decode the builder desperation that's reshaping 2026. The shocking numbers. Builder panic hits record levels. Let's start with the data that should make every real estate observer pay attention. In November 2025, 39% of home builders reported making price reductions on their inventory, according to National Association of Home Builders surveys. That's nearly 4 out of every 10 builders admitting they've cut prices to move homes. But that number only tells part of the story. 65% of builders, almost 2/3 of the entire industry, reported offering sales incentives beyond simple price cuts. That means mortgage rate buydowns, paid closing costs, free upgrades, appliances, landscaping packages, and other sweeteners designed to make deals happen. To understand how extreme these numbers are, consider historical context. In normal, balanced housing markets, roughly 10 to 15% of builders offer modest incentives at any given time. These are typically seasonal promotions, end-of-quarter pushes to hit sales targets, or competitive responses in crowded local markets. 39% cutting prices and 65% offering incentives represents nearly 3 times normal desperation levels. We haven't seen builder panic at this scale since late 2008 and early 2009, when the financial crisis crushed demand and left builders drowning in unsold spec homes. The trajectory through 2025 reveals accelerating crisis. In July 2025, around 28% of builders reported price cuts. By September, that jumped to 34%. November hit 39%. The trend is unmistakable and pointing toward even more aggressive discounting as we enter 2026. Incentive rates followed similar progression, climbing from 51% in July to 58% in September to 65% in November. Builders aren't just responding to temporary softness. They're reacting to structural market shift that shows no signs of reversing. Geographically, The panic concentrates in markets that overbuilt most aggressively during the pandemic boom. Phoenix leads with over 52% of builders cutting prices and 78% offering incentives. Austin follows closely at 49% price cuts and 73% incentives. Boise, Charlotte, Tampa, Dallas, and Las Vegas all register above 45% on price cuts. These aren't random markets. They're the exact metros that experienced the most explosive construction activity between 2020 and 2023, betting on demand that evaporated as quickly as it appeared. As we move through the final weeks of 2025 and into early 2026, every indicator suggests these numbers will worsen before improving. Builders have no choice but to escalate incentives as inventory continues growing, and buyer demand remains suppressed by high mortgage rates and affordability challenges. Anatomy of builder incentives. What's actually being offered? Understanding what builders are offering requires breaking down the specific incentive categories and calculating their real value to buyers. The most straightforward incentive is direct price reduction. Builders slash the list price by $50,000, $75,000, or even $150,000, depending on the home's price point and market conditions. In Phoenix, spec homes originally listed at $650,000 are now priced at $570,000. In Austin, homes marketed at $720,000 during summer 2025 now carry $595,000 price tags. These aren't subtle adjustments. These are panic reductions designed to generate immediate attention and traffic. But direct price cuts are just the beginning. The most powerful and widely used incentive in late 2025 is the mortgage rate buydown. Here's how it works. With market mortgage rates hovering between 6.8 and 7.3% throughout most of 2025, monthly payments on a $500,000 mortgage exceed $3,000, pricing out huge segments of potential buyers. Builders respond by paying lenders upfront to reduce the buyer's interest rate temporarily. A common structure is a 3-2-1 buydown, where the rate drops 3% below market rate in year 1, 2% below in year 2, 1% below in year 3, then adjusts to full market rate. So a buyer facing 7% market rate pays 4% year 1, 5% year 2, 6% year 3, then 7% ongoing. This dramatically reduces initial monthly payments, making homes affordable to buyers who couldn't otherwise qualify. Some builders offer even more aggressive 2-1 or permanent buydowns to 5 or 5.5% for the loan's entire duration. The cost to builders for these buydowns is substantial, often $30,000 to $60,000 per transaction, but it's less painful than letting inventory sit unsold accruing carrying costs. Paid closing costs represent another massive incentive. Closing costs typically run 2 to 4% of the purchase price, meaning $8,000 to $16,000 on a $400,000 home. Builders absorbing these costs eliminates a major barrier for buyers, especially first-timers who struggle to accumulate both down payment and closing cost cash simultaneously. Free upgrades add tremendous perceived value. Builders offer granite countertops, hardwood flooring, stainless appliances, upgraded HVAC systems, premium landscaping, fencing, and other enhancements that would normally cost $20,000 to $40,000 as optional add-ons. By including them standard, builders differentiate from resale competition and create urgency around limited inventory with desirable features. The real power emerges when builders stack multiple incentives simultaneously. A buyer might get a $75,000 price cut, a 2-1 rate buydown worth $40,000, $12,000 in paid closing costs, and $30,000 in free upgrades. That's $157,000 in total incentives on a home that might have been listed at $650,000. The effective purchase price drops to under $500,000 when you account for all benefits. That's a 23% discount from original asking. Those deals are happening right now in oversupplied markets as 2025 closes and 2026 opens. Why builders entered panic mode in late 2025. The builder panic dominating late 2025 didn't emerge randomly. It's the inevitable result of several converging forces that created perfect storm conditions. First and most obvious is oversupply. Between 2020 and 2023, builders went on a construction spree unlike anything seen since the mid-2000s bubble. Demand seemed infinite. Remote workers flooded Sunbelt markets. Inventory of existing homes vanished. Buyers competed desperately for anything available. Builders responded by ramping up production dramatically, acquiring land, launching new developments, and starting thousands of spec homes betting demand would continue. It didn't. By late 2023 and into 2024, demand began softening as mortgage rates spiked, affordability collapsed, and pandemic-driven migration reversed. But construction projects started in 2022, and 2023 couldn't be stopped. Homes take 12 to 18 months to complete. Developments take years to fully build out. The massive pipeline of projects initiated during boom times continued flowing into completion throughout 2025, creating inventory surge precisely when demand evaporated. Phoenix exemplifies this dynamic perfectly. Between 2020 and 2023, builders added over 45,000 new homes to the Phoenix metro area. Outer suburbs like Buckeye, Queen Creek, and Maricopa became ground zero for speculative development. By November 2025, inventory of new construction homes in Phoenix reached levels not seen since 2008, with over 11,000 completed or near-complete spec homes sitting unsold. Builders can't simply pause. They have construction loans that charge interest daily, land payments, subcontractor obligations, overhead costs for sales staff and model homes, and investor expectations for revenue generation. A completed home sitting empty for 60 or 90 days bleeds tens of thousands in carrying costs. The financial pressure to move inventory, even at painful discounts that destroy margins, becomes overwhelming. The second force crushing builders is brutal competition from resale inventory. During the pandemic boom, builders held competitive advantage because existing home inventory disappeared. If you wanted a house, new construction was often the only option available quickly. That dynamic reversed completely by 2025. Existing home inventory exploded as sellers who bought at the peak tried desperately to exit before losses deepened. Resale inventory in most major markets doubled or tripled year over year through 2025. Suddenly, buyers had abundant choice in existing homes, many priced below comparable new construction, even before builder incentives. Sellers of existing homes, facing their own desperation, slashed prices aggressively. Builders found themselves competing, not against other builders, but against desperate individual sellers willing to accept huge losses just to escape. To compete, builders had to match or exceed resale pricing while offering the advantages of new construction like warranties and modern efficiency. Hence, the incentive explosion. The third factor is financing pressure. Many large builders operate with significant debt, using construction loans and corporate credit lines to fund operations. As the housing market softened through 2025, lenders and bondholders began pressing builders to generate revenue, reduce inventory, and improve cash flow. Builders facing covenant requirements or refinancing deadlines had no choice but to prioritize sales volume over margins, leading to aggressive discounting to hit numbers that satisfied nervous lenders. The competitive advantage builders lost. Understanding why builder incentives matter requires recognizing how dramatically competitive dynamics shifted from 2021 to 2025. During the pandemic boom, builders held nearly unassailable competitive position. Inventory of existing homes for sale collapsed to historic lows, often below 1 month of supply in hot markets. Buyers desperate for housing had limited options: compete in brutal bidding wars for the few existing homes available, or buy new construction at whatever price builders demanded. Builders exploited this advantage ruthlessly. They raised prices monthly, sometimes weekly, extracting maximum value from inventory-starved markets. Incentives disappeared entirely. Buyers paid full price, covered all closing costs, accepted builder-preferred lenders, and often waived contingencies just to secure a contract. In many markets, builders used lottery systems to allocate purchase rights because demand far exceeded supply. Those days are gone, obliterated by the correction that accelerated through 2025. Existing home inventory surged as the seller delisting wave we discussed in previous analysis eventually breaks and forces relistings. Supply that was hidden off-market through much of 2025 floods back on as financial pressure mounts on delusional sellers. By November 2025, months of supply in markets like Phoenix, Austin, Tampa, and Charlotte reached 4 to 6 months, approaching or exceeding balanced market levels. Buyers suddenly faced abundant choice. That inventory expansion stripped builders of pricing power. Worse, existing homes often offer better value even before incentives enter the equation. Resale homes in established neighborhoods with mature landscaping, proven infrastructure, and proximity to services compete effectively against new construction in raw developments on the suburban fringe. Existing homes don't have mellow-roofs taxes or high HOA fees common in new developments. They offer known quantities rather than the potential construction quality issues that emerged during the rushed building frenzy of 2020 to 2023, when labor shortages and supply chain chaos compromised quality control. Builders must overcome these disadvantages with aggressive pricing and incentives just to generate consideration from buyers. The shift is stark and permanent for the foreseeable future. Builders won't regain pricing power until inventory normalizes and demand recovers, neither of which appears likely through 2026, given mortgage rate and affordability realities. Markets, where builder desperation peaks. While builder panic is nationwide, certain markets face especially acute crisis heading into 2026. Phoenix and Austin top the list, both experiencing catastrophic overbuilding during pandemic years. Phoenix added over 45,000 new homes between 2020 and 2023, while population growth slowed dramatically. Austin permitted over 38,000 new units during the same period, while tech sector layoffs and return-to-office mandates triggered reverse migration. Both markets now drown in new construction inventory that far exceeds demand. Builder incentives in these metros routinely stack to 15 to 25% of list price. Florida's major metros, particularly Tampa, Orlando, and Jacksonville, face similar dynamics. Construction boomed as pandemic migration brought workers from expensive northeastern cities. By 2025, that migration reversed, while insurance crisis and climate concerns scared away new buyers. Builders in Tampa suburbs like Riverview and Wesley Chapel offer incentives exceeding $100,000 on homes listed around $500,000. Orlando builders compete desperately with declining tourism sector reducing employment demand. Texas metros including Dallas, Houston, and San Antonio all overbuilt significantly. Texas offers abundant developable land and business-friendly permitting, allowing rapid construction expansion. But that same abundance ensures supply can overwhelm demand quickly when buyer appetite softens. November 2025. Data shows Dallas builders offering incentive packages worth 12 to 18% of home prices. Houston, facing additional pressure from energy sector employment uncertainty, sees similar desperation. Charlotte, Raleigh, Nashville, and other southeastern growth markets that attracted major corporate relocations and population inflows during pandemic years now face reckoning. Construction pipelines initiated during boom continue delivering inventory into softening markets. Charlotte builders report inventory levels triple those of 2022, forcing aggressive incentive offerings. Mountain West markets, including Denver, Boise, and Salt Lake City, experienced extreme price appreciation during pandemic that attracted heavy construction activity. Boise's explosive growth particularly captured attention, with home prices nearly doubling between 2019 and 2022. Builders flooded the market. By 2025, Boise faced severe oversupply as California buyers who drove appreciation stopped coming. Builder incentives in Boise routinely exceed 20% of list price. Las Vegas, with its boom-bust history, cycles through another downturn. Construction during 2020 to 2023 exceeded sustainable absorption rates. By late 2025, builders desperate to move inventory before year-end offered some of the most aggressive incentive packages nationally. These markets offer the deepest discounts for buyers, but also carry highest risk of continued price depreciation through 2026. Real opportunity for buyers. Evaluating true value. For buyers navigating builder incentive landscape in late 2025 and into 2026, the opportunity is real but requires careful analysis. New construction offers genuine advantages over existing homes when incentives bring pricing to competitive levels. Warranties are primary benefit. Most builders offer 1-year workmanship warranty covering defects, 2-year systems warranty covering HVAC, plumbing, and electrical, and 10-year structural warranty covering foundation and framing. For buyers risk-averse about maintenance costs and surprise repairs, this protection provides peace of mind that existing homes can't match. Energy efficiency represents significant long-term value. Homes built in 2023 through 2025 incorporate modern insulation, high-efficiency HVAC systems, LED lighting, and Energy Star appliances that reduce utility costs substantially compared to homes built decades ago. In markets with extreme climates like Phoenix, Texas metros, and Florida, monthly savings of $100 to $200 on electricity are common, adding up to substantial lifetime savings. Modern layouts and finishes appeal to buyers who prioritize open floor plans, large kitchens, primary suites, and contemporary aesthetics without needing renovation. The absence of deferred maintenance and aging systems means buyers can occupy immediately without the repair and update costs that often accompany existing home purchases. To evaluate whether specific builder deals offer true value, buyers must calculate effective price after all incentives and compare to comparable resales. Start with list price, subtract direct price cuts, add value of rate buydowns by calculating payment savings over the buydown period, add paid closing costs, and add fair market value of included upgrades. This total incentive package subtracted from list price reveals true acquisition cost. Then compare that effective price to recently sold existing homes of similar size, age, and location. If new construction comes within 5 to 10% of comparable resales after incentives, and you value warranties and modern features, the deal merits serious consideration. If new construction remains 15 to 20% more expensive even after incentives, resales likely offer better value unless specific features or locations justify premium. Be wary of inflated base pricing designed to make incentives appear larger than reality. Some builders artificially elevate list prices, knowing they'll offer massive incentives, creating perception of enormous deals when effective pricing isn't exceptional. Research what similar homes sold for recently in the same development to verify base pricing reasonableness. Hidden traps in builder incentive deals. While builder incentives create genuine opportunities, several traps can turn apparent deals into expensive mistakes for unwary buyers. The most significant trap involves temporary rate buydowns that create payment shock when introductory periods end. A 3-2-1 buydown reducing rates from 7% to 4% in year 1 creates monthly payment of approximately $2,100 on a $400,000 loan. When the rate jumps to 7% in year 4, the payment explodes to $2,660. That's a $560 monthly increase, over $6,700 annually. Buyers who budget based on initial payment often find themselves unable to afford the adjusted payment, facing refinancing necessity during market conditions that may not cooperate. If rates remain elevated or their financial situation deteriorates, they're trapped. Always calculate affordability based on the fully adjusted payment, not the teaser rate. If you can't afford the eventual payment, the deal isn't affordable regardless of initial terms. Many builder incentives require using builder-preferred lenders, limiting your ability to shop for best financing terms. Builder-preferred lenders sometimes offer less competitive rates or higher fees than external lenders, partially offsetting incentive value. Calculate the total cost difference between builder-preferred financing and best available market financing to determine if lender requirement erodes deal quality. New developments often carry hidden ongoing costs absent from established neighborhoods. Mellow Roos taxes in California and similar special assessments in other states add hundreds monthly to property tax bills for 10 to 30 years. Funding infrastructure development. HOA fees in new communities frequently start low, but escalate dramatically as developers transfer control to homeowners and true maintenance costs emerge. Monthly costs appearing affordable initially can become burdensome as these assessments increase. Location risk lurks in many heavily incentivized new developments. Builders offering deepest discounts are often those who built farthest from employment centers and amenities in raw land that offered cheapest acquisition costs. These fringe locations may face longer-term value challenges, as buyers prefer established areas closer to jobs, schools, and services. Commute times, school quality, and neighborhood maturity all affect long-term appreciation potential. Properties in the most remote new developments may underperform market averages even after buying with significant incentives. Construction quality concerns emerged during the pandemic building boom when labor shortages and supply chain disruptions forced builders to use less experienced crews and substitute materials. Homes completed in 2022 through 2024 may harbor quality issues that won't surface until warranties expire. Rushed construction sometimes means missed details, improper installation, and premature system failures. While warranties provide protection, dealing with warranty claims creates hassle and doesn't compensate for diminished enjoyment of your home. Finally, depreciation risk in oversupplied markets means homes bought today, even with incentives, may lose value through 2026 as correction continues. If your market faces 3 to 4 years of inventory and prices are still falling, buying now means negative equity risk in near term. For buyers planning long-term ownership, this may not matter. For those who might need to relocate within a few years, buying into falling market is dangerous, regardless of incentives received. What builder panic signals for 2026? The builder desperation dominating late 2025 sends clear signals about market trajectory through 2026. First, inventory will continue growing as construction pipelines complete. Projects started in 2023 and early 2024 still flow into delivery through first and second quarters of 2026. This inventory surge ensures downward pressure on prices persists for at least 6 to 12 more months. Builders can't reduce supply quickly. They can only manage existing inventory through aggressive incentives and hope demand eventually recovers. Second, expect incentive escalation through at least first half of 2026. If 39% of builders cut prices and 65% offered incentives in November 2025, those numbers likely reach 45 to 50% price cuts and 70 to 75% incentives by March or April 2026. Builders entering New Year facing full inventory and first quarter traditionally representing slowest sales period will panic further. Incentives that seemed aggressive in late 2025 will look modest compared to what's coming in early 2026. Third, builder bankruptcies and consolidation will accelerate. Smaller and mid-sized builders without deep capital reserves or diversified geographic presence face existential threats. Several regional builders already announced restructuring or filed bankruptcy through 2025. That trend intensifies through 2026 as prolonged downturn exceeds financial capacity of weaker operators. For buyers, this creates both opportunity and risk. Distressed builders offer deepest discounts but may lack resources to honor warranties or complete punch list items if they fail. Fourth, geographic divergence will increase. While national data shows widespread builder stress, some markets will stabilize sooner than others. Markets with constrained supply, strong employment fundamentals, and limited speculative overbuilding during boom may see builder incentives moderate by late 2026. Markets drowning in oversupply like Phoenix, Austin, and Florida metros will likely see aggressive incentives persist into 2027. Understanding market-specific dynamics becomes crucial for timing decisions. Finally, the builder capitulation we're witnessing creates foundation for eventual recovery. Markets correct through price adjustment until affordability improves sufficiently to restore demand. Aggressive builder incentives accelerate that price discovery process. Once inventory clears and prices reach levels supported by local incomes and employment, demand recovers and the next cycle begins. We're not there yet, but the pain builders experience today is necessary precursor to healthy market tomorrow. Strategic playbook: buyers, investors, and market timing. For first-time buyers, builder incentives in late 2025 and into 2026 present legitimate opportunity if approached carefully. The combination of lower effective prices through incentives, warranties reducing repair risk, and modern efficiency reducing operating costs makes new construction competitive with resales for the first time in years. If you plan long-term ownership, can afford fully adjusted mortgage payments when rate buydowns expire, and find homes in developments with reasonable locations and manageable ongoing costs, buying now captures value. Focus on markets where oversupply is clearing and employment remains strong rather than most distressed markets where further price declines are likely. For move-up buyers, the calculation is complex. If you currently own a home bought before pandemic peak, you likely have significant equity. Selling into still elevated market to capture that equity, then buying new construction with builder incentives can be smart. However, if you bought near peak in 2021 or 2022, you may face negative equity or minimal gain. Selling at loss to buy new construction, even with incentives, rarely makes financial sense. In that case, stay put until either your equity position improves or market stabilizes. For real estate investors, builder incentives create interesting rental property opportunities in specific markets. Calculate rental yield by dividing annual net rental income by effective purchase price after all incentives. In markets where incentives reduce purchase prices significantly while rents remain stable, yield can reach 6 to 8%, attractive for long-term rental strategy. However, avoid markets with severe oversupply where rental competition will intensify and appreciation unlikely for years. Also account for potential builder warranties transferring to tenants, reducing maintenance costs during initial ownership years. For wait-and-see buyers, patience remains appropriate strategy in most distressed markets. If your market shows rising inventory, falling sales volume, accelerating price cuts, and increasing days on market, correction has further to run. Builder incentives will likely improve through first half of 2026. Unless specific property offers extraordinary value or meets unique needs that justify buying now, waiting 3 to 6 months will likely improve your negotiating position and options. Watch for signals that indicate approaching bottom, inventory stabilizing or declining, sales volume recovering, price cuts slowing, builder incentives plateauing rather than accelerating. Those indicate correction nearing completion and timing shift from waiting to acting. The bottom line on builder desperation. 39% of builders cutting prices and 65% offering incentives in November 2025 tells a clear story. The housing market correction that began in late 2022 and accelerated through 2023 and 2024 is far from over as we enter 2026. Builders, who benefited enormously from pandemic boom, now face the consequences of overbuilding into softening demand. Their pain creates opportunity for informed buyers willing to do the analysis and accept the risks. These aren't charitable gestures from benevolent builders. These are desperate measures from companies facing financial pressure that will only intensify through early 2026. But desperate sellers often make the best deals for shrewd buyers. The key is separating genuine value from trapdoor deals that appear attractive superficially but carry hidden costs or depreciation risk. Calculate true cost after all incentives. Compare rigorously to resale alternatives. Understand the ongoing costs of new developments. Verify you can afford fully adjusted payments when rate buydowns expire. Research the builder's financial stability and construction quality reputation. Choose locations carefully, favoring established markets over fringe developments. If all those factors align favorably, builder incentives in late 2025 and into 2026 offer legitimate opportunity to acquire new construction at prices that won't return once correction completes and markets normalize. For those who can't make the numbers work or who see too much risk in their target markets, patience through first half of 2026 will likely be rewarded with even better opportunities as builder desperation peaks. Knowledge is power. Understanding what builder incentives really signal, what they're actually worth, and what risks they carry separates smart deals from expensive mistakes. If this breakdown gave you the insights to navigate builder desperation intelligently, smash that like button right now. Subscribe to Housing Intel for the data-driven analysis that turns market chaos into strategic advantage. Drop a comment below. Are you planning to take advantage of builder incentives in 2026? Which market are you watching? Tell us your strategy. We'll see you in the next breakdown, where we reveal which markets will offer the deepest builder discounts through 2026 and where smart money is positioning for maximum opportunity.